This is a new edition of Global Ag Trade. Here we focus on trade policy involving the United States and the BRIC countries and the impact in agriculture. In this particular episode, we will discuss what we think is going to happen with Mexico and its trade relationship with the United States and the current state of affairs in Brazil and its impact in agriculture. Right here on Connected Farmer, your channel to keep you up to date with the latest trends in agriculture and livestock. So Mike Zuzolo is ready to talk to us about that, about the next trade intentions of Mexico, and yet about the Brazilian macroeconomics and its impact in agriculture. But before we jump into that, I want you to subscribe to our channel. We have seen a very good reaction in our first episode, and we want to still have more and more subscribers and followers. So don't hesitate to put your thumbs up and subscribe. So Mike, we have had a market reaction with the situation in Brazil. The real has had a devaluation yesterday and is still today an ongoing devaluation. The Brazilian central bank has been intervening, but it has not worked so far. It seems that the Brazilian market players are not trusting the government.
Yeah, and it's an interesting dynamic in Brazil. Their inflation is not as high as you would think it would be. It seems to be more of a lack of confidence. And so I am a little bit suspicious as to why the central bank came in and defended the currency. It seemed like they were using a lot of firepower and kind of wasting it, if you would, Luis, in my view. And this is coming off also of an emergency operation from the president Lula with his big operation. I think he's had two now and was in critical condition. And I'm wondering if some of that wasn't some spillover issues too. But this is one of those markets that I don't like the setup of what's happening as far as why we made new record lows against the dollar in that real. And I think that this is really important because we're already seeing kind of a stressed soybean market globally. We've already gotten to the point where US Gulf of Mexico beans are about $30 a ton more expensive than Brazil. And I think the market really tapped into this new record low in the currency, in the Brazilian currency against the greenback, because we've already been pressured by the weather in South America and the fears of the trade. And I'll throw one more log onto the fire, unfortunately, and that was the crude oil market really giving up on some more negativity in China over the last weekend and their economic data. Retail sales in particular has been talked about a lot in the commodity markets these past three sessions since the weekend trade. And that really blended into the soybean oil. The soybean oil market was kind of the dog of the day on Tuesday's trade, down about 3.5%. That too is another one of those markets where we've already gotten the meal down to almost a still sitting around about a 4-year low. I'd hate to see the bean oil give up here on the ideas that the biofuel and the trade issues we're going to make longs unwrap there as well. So we're kind of in a tenuous spot with new monthly lows and lead month beans, new contract lows in November 25 beans. We need some good news in the soy complex to kind of heal up this market.
Well, and all of this trend with the Brazilian real might affect the agricultural markets strongly. If that trend continues, the Brazilian farmer might want to wait to sell its soybeans, just like in previous years, the Argentinian farmers wait as long as they could to sell soybeans. Brazilians might follow suit in that, but it also would make the Chinese even more interested with the Brazilian soybeans, as you anticipated our in our previous episode.
Yeah, and I think this is where there's a big distinction still between the corn and the soy, and the market's very well in tune with that. And that soybean corn ratio in the new crop, November 25 beans against December 25 corn, went down on an intraday basis. I saw it go down to 2.25. I believe that's the lowest since June or September of 2022. And so, we are being told in the United States very bluntly, do not plant soybeans, plant corn in the new crop springtime. I feel like we're a little bit ahead of the curve, though. I think we've almost put the crop to bed in terms of what the weather side of the equation is. And when you talked about the farmers coming in and maybe holding and not wanting to sell too much if the real weakens more, would they throw in the towel in February or March, or what would be their traditional game plan as far as how long would they be willing to not sell into the market?
Well, in previous years, the most farmers they would sell right after harvest, but with this changing scenario, they might wait some another couple of months to do so.
So that would be your center west Brazil crop that would be coming off in what, January, February, and they maybe would wait until April, May to sell. Is that what I'm hearing?
Exactly, exactly.
Okay, that would it be that the reason I asked that, Louise, is because we're really running into a situation where here in this country we're going to have a lot of on farm storage that needs to be sold, and I think that's going to happen pretty soon. We are now in the second half of December. I get the sense from the clients I work with that they've got a little bit of beans left, maybe more than they want at this stage, and so I think that'll be the first thing they'll let go of, just because of the cash flow needs, and they like farmers like storing corn anyway. But I would say that in the next 2 weeks we may have quite a bit of farmer related selling that could come our way as well. So it's going to be a pretty tough time if the beans don't jump and find some support, especially after the January report. I think that's where I'm lining up at this point with my clients and with the market in general. U.S. farmers, I think, are expecting another yield decline in soybeans for the U.S. crop in that January crop report, wanting to see if we don't get another corn yield decline as well, maybe just as an extra bonus. But if they don't get that, I think they'll start selling, and they'll probably start selling regardless in the second half of January. So that's kind of something we want to get ahead of in case this market continues to weaken, and the look of the trade issues that we're dealing with as we get close to inauguration on the 25th, I think, of January. We need to really start understanding that more.
Okay, now let's jump into Mexico. President Donald Trump the president-elect of the United States has promised to impose several tariffs if certain conditions are not met with Mexico. There is kind of a repetition compared to his first term, but this time around, Mexico seems to have a tougher stance, doubling down, but it doesn't seem to be a good strategy for them because no country in the world is more dependent of the States than Mexico. 90% of their exports go to United States. Mexico has yearly more than 37 million American tourists, and yet I don't have the raw number right now, but a lot of their revenue comes from Mexican workers in the United States. So, what do you think is going to happen? Because last time around, any of the talks uh, with of Mexico with South America, which is basically Brazil and Argentina, have not worked because the United States is a lot more competitive and is integrated in its infrastructure with Mexico.
Yeah, and I'm glad you brought that up because I think one of the biggest differences that when I started digging into Mexico and why I thought to myself, why is President Trump, other than the border and the fentanyl, why is he going so aggressively into the Mexican trade and to a lesser degree the Canadian trade because of USMCA and the agreement that he signed the first time he was president, the first term. And I think it's because China has really been building up what you would call a connector country type mindset with Mexico. There's about five countries that China has started to create a much deeper relationship with economically. And in the case of Mexico, they're one of the greatest of the five that I dug into. The exports between 2020 and current, heading from China to Mexico, have increased in just 4 years by about 80%. And so I think what President Trump sees is that you can slap tariffs on China, but they've got enough infrastructure they've built up over the last 8 years or 5 years, whatever you want to call it, that they could get around the tariffs through Mexico. And they have huge areas that they've purchased and put industrial plazas in to, be building infrastructure and be building manufacturing and automotive loadouts that would then ship across the United States border. And so I think this continues with the theme of our first episode, that this is a much different scenario. It's a very much more significant and serious scenario because it suggests to me that President Trump does want to use the tariffs as a negotiating tool, but he also will use them if the negotiations don't go well, because China and Mexico have such interconnected supply chains that eventually take end goods or finished goods into the United States. And so if he's going to make good on his tariff threats, and he wants the reciprocity that his new commerce secretary designee used in a press conference this week when talking about China and trade, they want the reciprocity of better bilateral trade with China, and they're lumping Mexico into that because of this infrastructure build out that China has been doing. But I guess the big thing that I would say, as far as the corn and the pork markets go, is that China, I think if we could get China to work with the United States and the new administration, Mexico would handily come along for the ride. And then Canada would be more of a non factor because I think the dominoes would fall. So at this stage of my analysis, I would be pretty strongly of the view that President Trump needs to focus a lot of his attention on China. And if he can get China to get an agreement with, Mexico will fall into line very quickly because of this infrastructure supply chain relationship they have now with China and what you talked about with the United States. And then I think Canada would see, okay, what's happening down in the south of the border? We don't want to be left out. Let's jump on board and strike a trade deal with the United States as well.
So you wouldn't be pessimistic about corn demand at this time, since Mexico is a large importer.
I looked at that, and right now I would not be, only because even if I'm wrong about the trade relationship and if things go badly with China and therefore badly with Mexico, where else could Mexico go to get corn? And I don't think Brazil has the corn right now. I mean, USDA is talking about 24.5 million metric tons of corn exports coming out of the United States into Mexico. That's going to be about 965 million bushels. I still feel as though that Brazil's crop from last year is 3 to 5 million metric tons smaller than what USDA is still projecting. I think there's still a 122 million metric ton corn crop in Brazil for last year. And if that's correct, and I'm correct on that, then I think they're going to have a lot tighter exportable supplies than they're used to having, and maybe more like what they had back in 22, 23, where it was only in the mid to upper 20 million metric ton levels. And so I think between the Mexican drought still very much in play and also a tightening situation of corn in Brazil, I'm not as nervous about the corn initially. I do think they front end loaded some of their needs, and it would surprise me that they would cancel corn at this point. But I think what they'd probably rather do if things didn't go well is they just try and use up as much as they possibly could and kind of go dark for a while and not purchase nearly as much as they have. I do think they have kind of come in and bought a little bit extra ahead of President Trump's victory, because some of the recent USDA data shows that. And we've got a chart to provide for the viewer on that this week.
Yes, and from last time around, that the U.S. and Mexico had a trade dispute, the purchases by Mexico from Brazil were minimal and were from trade companies that I also corporate farmers in Brazil. So they are a lot more competitive than most farmers, but they don't have enough volume to cover all of this demand from Mexico.
Yeah, that's a really key point to make is that the logistics and also the infrastructure really probably hasn't been built up enough. And this is where I've seen a couple studies done that in gaming out the tariffs as, a 25% tariff on Canada and Mexico, and then the additional 10% on China, but not going all the way up to 60% on China, would suggest that 2026 and 2027 would be the years that would really start to hurt. I think the commodity markets in particular, and haven't dug too much deeper than just a couple studies right now, but I think it's worth mentioning that. I think one of the things that is a continuation of what we talked about on that first episode, Luis, is and I want to be consistent about this unless I find something very surprising that I need to bring to you and the viewers' attention. But I think it really does go back to what does China do this time around, because China's economy is clearly suffering. I mean, their retail sales just came out over the weekend, as I talked about earlier. I think they were up 3% in November. They missed the average trade guest, though, by almost 2 percentage points. Their real estate property levels are still, their valuations are still dropping, not as badly as they had been, but they're still dropping. And the domestic demand is such that I've started to see some articles come out of Asia that the social unrest is actually increasing in China. You're seeing more attacks. You're seeing more cars running into people. You're seeing a lot more of social unrest, and some in Asia that I understand and work with would suggest that that may be directly related to the lack of prosperity that the Chinese people feel right now. And so it's a real big question mark how President Xi is going to move this dynamic along given his domestic issues. And one last statistic that I think really hurts the Chinese when it comes to the global economy, and this is where the keeps the funds on the sidelines from buying commodities right now, is China's November capital outflows, money going out of the country, hit a record in the month of November, almost $46 billion US. But it was a record monthly outflow just this past November. So clearly, the world investment community is not supporting the idea that China is coming around. So President Xi's definitely on the defensive. I hope that he doesn't, double down and you just go for broke and say, we're not playing ball. And he sees a pathway with President Trump to bring this whole thing out, very quickly in the first 100 days of President Trump's presidency.
So you just see a tougher negotiation, but that will end up with a settlement, and most likely the U.S. would win this dispute.
I think President Trump and President Xi would frame it that they would, and I don't know either. I don't know anything about their policies. I'm just talking about from an academic standpoint. I think they're both proud enough men and populist enough men. There would not be a clear winner in their negotiation. They would both say they won. And I think that'd be the best for world trade at this point. I think that's one of the things we learned from the first term of
But
President
yeah, I
Trump.
was referring more into the dispute with Mexico.
Oh, I see what you're saying. Yeah, exactly. If we get an agreement where President Trump looks like he got something with China, I think Mexico would be right there ready to sign a deal and then Canada follow.
Yeah, I still wanna have your word about the energy markets. What are you feeling right now? Because seem a lot of factors have come down in the Middle East and other parts of the world. Do you think that would help put the oil and other energy prices down?
Yeah, I don't think the oil market. I was talking to clients and subscribers the last 4 or 5 weeks about a potential buy signal in the crude oil, but I had not gotten that buy signal yet. And one of the big reasons that I hadn't seen it technically, I think now in hindsight, is because this Chinese economic policy that they had the big meeting last weekend did not go anywhere, and I think that's really hurt the crude oil upside. So unfortunately, I think we're going to have to go down and test the support levels again in the crude oil market. And that would make sense from the standpoint of what's happening with the United States and China, because the more we sanction Russia, the more we sanction Iran, the more China's going to have to come to countries like us for their oil and for their propane. But that's all part of it as well. And I think right now the market's nervous about that and not ready to buy.
Well, Mike Zuzolo is the head of Global Commodity Analytics. If you want to have deeper analysis, make sure you sign up to his newsletter. And I thank you, Mike, for all your support to the channel.
And thanks to you, Luis, and your expertise, and a Merry Christmas to you and all the great viewers out there.
Thank you.